We've seen that passive screens are one of the approaches that can be used to try to exploit a philosophy that is based on value investing. In this learning objective, we look at different passive screens that can be used by investors and analyse the evidence regarding the efficacy of such screens. So, as we've spoken about earlier, the key founding father of value investing was Ben Graham. And Ben Graham, back in the middle 20th century, had a range of screens that he applied in order to identify stocks that had a low price relative to their fundamental value. And what we can actually see on the screen here are the 10 passive screens that Ben Graham adopted. And his view was you should buy stocks that meet all 10 of these screens. As you go through the screens, what you can actually identify that all 10 screens are, in some ways, measures of the price relative to different aspects of the fundamental value of the firm. So, number one, the price-earnings ratio of the stock has to be less than the inverse of the yield on corporate bonds. So basically wants low price-earnings ratio. Remembering the price-earnings ratio is the ratio of share price to earnings per share, or it's a measure of how many times multiple earnings do you have to pay to buy that stock. So he wants a low PE ratio, and also he wants the PE ratio to not only be low in terms of its magnitude, but also be low relative to other firms in the market. He wants stocks that have high dividend yields. So dividend yield's got to be greater than 2/3 of the corporate bond yield. And stocks that have a low price relative to both their book value and their net current asset value. Furthermore, another way that Graham looks at passive screens is he wants stocks that have relatively low levels of debt on their balance sheet. So they've got to have a debt to equity ratio less than 1. Current assets need to be at least twice current liabilities, so it has to be a highly liquid firm. Again, low levels of debt less than twice net current assets. But also then firms that have strong prospects, because he's looking here at historic growth in earnings per share greater than 7% and no more than 2 years of negative earnings over the past decade. So a range of different ways, and when all these rules come together, he's looking at firms with solid business fundamentals that have a low price relative to some measure of their fundamental value. So the question is, how well did Graham's screens perform? Well, one way that we can really clearly evidence the success of Graham's approach is the fact that we're still talking about him today. Ben Graham is viewed as a very highly successful investor, and his approach to investing has been adopted by literally thousands and more than likely millions of investors through history. If we look at some of the academic evidence regarding the performance of Ben Graham's investment strategy, Oppenheimer in 1984 reported that stocks that passed all of Graham's screens were actually able to earn a significantly higher return than the market. However, while there was evidence back in the 80s that Graham's approach worked well, what we've found since is that subsequently there is more limited evidence about the success of Graham's strategy. And this doesn't so much speak to the lack of the ability for value investing to continue to be working. More, it reflects the change in market mechanics, whereby you actually find very few, if any, firms that nowadays meets all 10 of these screens. That's largely due to decreasing dividends, much more higher use of leverage by firms. So very few firms actually satisfy all his requirements. And that's meant that while the general idea behind what Graham suggested all those years ago is still relevant today, maybe a mixture, a different range of passive screens might be required, and maybe a slightly more parsimonious approach whereby there's not quite so many hurdles that firms have to jump over in order to be successfully included within a portfolio. As I said before, probably Buffett's best claim to fame is the success of many of the students who took his class on value investing and learned from his approach. And the most famous value investor of all was one of Ben Graham's students, and that's Warren Buffett. So Warren Buffett is a value investor who also, according to his books, uses a range of different screens. Only the screens used by Buffett are quite substantially different to those that were applied by Ben Graham. So same basic underlying philosophy, but different way of executing the investment strategy. So Buffett believes in 4 tenets, so 4 different features that you look at to identify a good value stock. So he's got the business tenet, is that the business should be in a simple, easy to understand industry and should have a strong history of operating profitability. Management tenets is Buffett believes in meeting the managers of the firm and ensuring that they're good leaders and also well qualified to be able to lead the firm. The financial tenets, he says that the firm should have a higher return on equity and hence should have good profitability across time, with owner earnings being quite high and quite stable across time. And also market tenets. Buffett often talks about this idea of Mr. Market, and this is the view that there are outside forces that can affect the valuation of businesses and the valuation of stocks. So Buffett tends to use very conservative estimates when valuing companies. And what this will mean is, because of the use of conservative estimates, is that only those firms that are extremely cheap relative to his estimation of fundamental value will actually fall into his portfolio. So if we can compare Ben Graham versus Warren Buffett, as I said, the same basic principle, the same idea of trying to identify stocks with a low market price relative to the fundamental value, we can see that the screens they use are very different, in that Ben Graham's are systematic screens. They're clear, they're objective, and there's no subjectivity involved. It's a decision rule, and you could program a computer to trade with an algorithm based on the rules that are set up by Ben Graham. Whereas Buffett's 4 tenets are highly subjective, and there's a lot of discretion involved, and this could be argued to be the main reason why many investors have tried, but very few have succeeded in replicating Buffett's approach. It requires his own secret herbs and spices, his own ability to look managers in the eye and assess their prowess as leaders and as people, and his own ability to look at the business and inspect it and examine the prospects of that particular business. So the problem with Buffett's approach is that we as other investors, unless we're able to have his particular skill and his particular access, this is probably an approach that can't be replicated by the average investor. Probably what a value investor will be looking for is a more systematic approach, a more rules-based approach that didn't involve the subjectivity that's incorporated into Buffett's approach, because most investors won't have his innate skill set, or more particularly won't also have his access to managers and to businesses. So let's look at some alternative value screens that we might think about if we're trying to look at an appropriate, systematic, objective value investment strategy that is relevant in the 21st century, hence doesn't have the degree of complexity that maybe Ben Graham's screens had. So the 4 most common screens that tend to be used by value investors are the book-to-market ratio, price-earnings ratio, price-to-cash flow ratio, and dividend yields. All of these ratios are effectively a measure of current price as a ratio of the fundamental value of a firm. So if we look at book-to-market ratio first of all, book-to-market ratio is the book value of the firm, or the accounting value is being used as the firm's fundamental value, as a ratio of the market value, or the price. So if you've got a high book-to-market ratio, it means the accounting value of the firm is high and the market price of the firm is relatively low. So a firm with a high book-to-market ratio would be seen as a cheap stock that one should buy. Price-earnings ratio, we mentioned before. Price-earnings ratio is the ratio of share price to earnings per share, or it's the multiple of current earnings that you have to pay to buy that stock. Hence, a low price-earnings multiple would imply a cheaper stock or a value stock. Price to cash flow, similar to price to earnings, but instead of using total earnings, it just uses the net cash flows of the firm. It's the view that net cash flows is a better indicator of overall firm performance than total profit. And just like the price to earnings ratio, those firms would have a share price that is a low multiple of net cash flows are those that should be bought. They're value stocks, they're relatively cheaper. Last of all, dividend yields. The idea that stocks with high dividend yields, that's the view that if we take, say, a dividend growth model approach to valuing a firm, we can see that the dividends paid to shareholders is like an annuity stream, or a growing stream of cash flows through time that can be used to value the fundamental price of a firm. And if you've got a dividend yield, that's the ratio of the dividends paid out to the price. So a high dividend yield basically means high dividends, low share price. Therefore, they should be stocks that are also value stocks. So a couple of rules that need to be applied if you are going to consider value screening. value does not outperform growth in every single time period. On average, evidence suggests that value outperforms growth. So if you have a long time horizon, this should be a successful investment strategy, but should not be used for investors that are only seek to invest for a short period of time. It's also important that investors choose their screens wisely. Too many screens might result in the Ben Graham problem, whereby you actually eliminate all stocks and you find no firms at all are able to meet the requirements of the screens, whereby too few screens might be far too simple. So yeah, maybe it's a combination of a couple of screens that might be best. But again, this is where back testing can also be an important way to identify an appropriate approach for an investor, with a view to also minimising the turnover. Farmer and French, in their study in 1992, actually compare all these different value screens that we've just discussed, and they argued that the book-to-market ratio is the most effective predictor of future returns, so their view is it is the approach that should be used as a passive screen by value investors. So having a look at these 4 different screens, let's actually have a look at the evidence of the performance of each of these screens for about the 60 or so year period from 1952 through to 2011. So what I've done is I've taken those 4 screens we looked at before. I've formed portfolios at the start of every year by ranking stocks based on these screens, and based on the direction of the screen, the top 10% of value stocks, called the value portfolio, the 10% of for each of these screens of growth stocks, called growth, and then we've got all the deciles in between. Each of these portfolios are then held for 12 months, and just like with the momentum strategy we looked at previously, there is annual rebalancing. So at the end of each year, I'll reevaluate all these ratios, and I'll identify once again, I'll rank stocks based on, for example, their book-to-market ratio. With respect to book-to-market ratio, a high book-to-market ratio means value. So the top 10% of book-to-market ratios at the end of the year will be my value portfolio for the next year. Bottom 10% will be my growth portfolio, and I'll hold those portfolios for the next 12 months and continue to do so through time for our whole sample. Now what we can see is that across all 4 screens, there's basically, as we go from left to right, a trend upwards. That is that on average, our value portfolios tend to outperform our growth portfolios. And that evidence is quite strong for book-to-market, price earnings, and price-to-cash flow ratio. With respect to all 3 of those screens, there's quite strong evidence. The evidence isn't as strong at the back here for dividend yield. Dividend yield is a bit more of a mixed bag, so that accords with the argument that it's probably the weakest of these 4 passive screens. What if we look at this numerically? So here what we've got is the zero investment returns. And by zero investment returns, I basically say, what if I took a long position in the value portfolio and a short position in the growth portfolio? Or in layman's terms, what's the average return difference between the value portfolio and the growth portfolio? And what we report here is the average return difference per month in percentages. So for the book-to-market ratio, value stocks outperform growth stocks by about 0.41% per month. That number is 0.53 and 0.55 for price earnings and price to cash flow ratios respectively, and quite low for dividend yield. Now if we're thinking from a statistical perspective, for book to market, price earnings and price to cash flow ratio, the difference between the returns on the value and growth portfolios is statistically significant. Okay, so not only are we seeing economically large return differentials of about 0.5% per month, but from a statistical perspective, they're also significant. So that's the evidence for the US. What about Australia? Well, there's been research that's looked at this issue in the Australian market. Here what we can see is portfolios formed on the book-to-market ratio in Australia for a period of approximately 30 years, where we've got 5 are our value stocks, high book-to-market ratio. 1 are the growth stocks, and you can see again this monotonic increase, value clearly outperforming growth using this metric, and the return difference in this case is about 0.6% per month. So value investing appears to outperform across the world, and there appears to be a few different screens that can successfully pick up value stocks and be used to generate abnormal returns. Given its success, this investment strategy has actually been adopted by a large number of managed funds around the world. One example of such a fund is Dimensional Fund Advisors. Dimensional Fund Advisors, interestingly, have Eugene Farmer and Ken French as consultants, and we spoke before, they're basically the key academic drivers behind this idea of a value anomaly. The DFA have an Australian value trust, and just as of interest, we can look at some of the names that are held within that trust, and they tend to be large Australian companies that at any particular point in time might be considered to be value stocks. Just to finish up with this learning objective, what are the determinants of success with being a passive screener? Well, we spoke before, you need to have a long time horizon. Value does not outperform growth in every single month. It is on average over a long time period that value outperforms growth. You need to choose your screens wisely. There's a range of different potential value screens that can be used, some of which have more efficacy than others. Value is also an investment strategy that is based on averaging. So just like value does not outperform growth in every single month, not every value stock outperforms every growth stock. It is simply just the average portfolio of value stocks outperforms the average portfolio of growth stocks. So the important point here is that you need to be diversified. It is not simply just a matter of investing in one value stock and expecting it will outperform the market. And like with any investment strategy that moves away from passive indexing, you have to be careful about taxes and transaction costs. So being aware that some screens may end up creating a portfolio of low price stocks, but those low price stocks might be small neglected stocks that have high transaction costs, and also being aware of frequently turning over your portfolio.